The folder has one number on the cover, $940 million. Not your money. You are 29 years old, sitting across a table from a man named Whitmore in a room with no signage, no logo, no reception desk. Just 2 glasses of water and a silence that costs more per minute than your annual salary. He slides the folder toward you. Inside, your last 4 research notes, annotated in blue pen, not highlighted, annotated, every margin filled. Someone has been reading you very carefully for months and chose not to tell you until now. You think this is a job interview? It is not. It is the beginning of an education that will make everything you learned before feel like a rough draft. Whitmore says one sentence. He says, "We don't sell. You don't understand yet. You will. You cover mid-cap industrials at a second-tier asset manager. Your fund holds $4.2 billion across 60 positions. You own 8 of them. Every morning before anyone else arrives, you open 3 monitors and begin earnings releases, management commentary, sell-side updates that repeat each other in slightly different fonts. You believe the market is a mechanism for price discovery. Your job is to find where the mechanism is wrong. That belief is about to be permanently corrected. The call comes on a Tuesday in October. Unknown number. The voice is calm the way surgeons are calm. The voice belongs to Whitmore. He represents a family office managing $3.1 billion in private assets. The family holds 22% of one of your companies. He wants to meet before Friday's earnings call. You go. No signage on the building. The elevator requires a key card. The floor requires a different one. The folder on the table contains your own work, annotated by someone who understood it more completely than your own VP did. The family purchased the position 11 years ago at $4.12. It trades at $31 today, 600% return, fully valued by every metric you have ever used. You say exactly that. You frame it cleanly. The rational move is to realize the gain and redeploy. Whitmore looks at you the way a chess player looks at someone who just moved their queen into danger without understanding why the danger exists. He says, "Walk me through the tax. Federal capital gains at 20. Net investment income surcharge at 3.8. State at 4.95. On $280 million in unrealized appreciation, a sale produces roughly $80 million paid immediately and permanently. The position is gone. The cash is already smaller, already eroding, searching for somewhere to go that will probably perform worse." You say, "That's the cost of realizing the gain," he says. "Or is the cost we choose not to pay." He slides a term sheet across the table. A $190 million lending facility. Annual interest at 3.4%. No sale, no tax event. The family borrows liquidity into existence and the asset keeps compounding. They never gave it up. The cash arrived without the consequence. You are quiet for a long moment. Whitmore says, "Our job is to make sure we never have to find another security again." That night, you model both scenarios. Scenario 1, the family sells, pays the tax, reinvests at 8% annually. Scenario 2, the family borrows at 3.4, holds the position, lets it compound untouched. 30 years forward, the gap is generational. $340 million more, not from a better investment. The return assumption is identical. The only difference is what they refuse to pay. You stare at the output cell for a long time. The math is almost brutal once you see it clearly. You take the engagement. The first year is entirely structural. You are not analyzing companies anymore. You are mapping how old money stays old. Real estate held through LLCs, each one a legal container separating liability from asset. Equity positions inside a trust designed to step up cost basis at death. The embedded appreciation disappearing for heirs entirely. A stake in a private credit firm where carried interest is taxed at long-term rates rather than ordinary income. Every asset chosen not only for return, but for tax character, leverage, utility, and longevity. This is not a portfolio. It is a machine designed to generate spending power indefinitely without triggering the event that diminishes it. In the second year, Whitmore introduces you to a second family, third generation, toll roads, a water utility, a portfolio of cell towers. These assets generate cash every month regardless of market conditions, regardless of rate cycles, regardless of who is in office. The family calls it permanent income, income that cannot be stopped. A sovereign wealth fund makes a clean offer for the water utility. 12 times EBITDA, $680 million. The family's cost basis, $18 million from a purchase made in 1987. The patriarch does not ask about the buyer. He does not ask about the multiple. He asks one question. What do we borrow against it today? The answer is $290 million at 4.1%. He says, that's enough for the next project. He thanks everyone, and the meeting ends. You understand something in that moment no spreadsheet ever showed you. The offer was never real to him. Selling is not a transaction to this family. Selling is an ending. Every asset is a permanent claim on the world's productive output. To sell is to trade something permanent for something temporary. Cash taxed on arrival, eroded while it sits, reinvested into something almost certainly inferior. You walked in thinking about exits. You walk out thinking about forever. By the third year, you are building a technology founder with $1.4 billion in a single equity position. He cannot sell without collapsing the stock and triggering a catastrophic tax event simultaneously. You construct a solution using an exchange fund. The founder contributes his position to a partnership, gain deferred entirely. 4 months. Legal fees, $2.4 million. When it closes, he calls from somewhere on the water. He says he feels like he won something without giving anything away. He did. You begin to understand leverage in its original form, not as risk, as a tool for creating liquidity from illiquidity without touching the asset. The wealthy do not think in portfolio volatility. They think in collateral quality. Real estate earns rents and also secures a credit facility at 50% loan to value, which funds the next acquisition, which becomes the next node in a lattice where each asset supports the others. Removing one piece weakens every surrounding structure. You stop thinking in positions. You start thinking in permanent systems. In the 4th year, an activist moves against a holding company controlled by an old family. He demands the sale of its real estate assets. The logic is clean and correct by every conventional measure. It is exactly the logic you would have used 3 years ago, but you are no longer on that side. The family owns 41% of the equity. Embedded gain, $940 million. A forced sale costs $260 million in taxes before a single dollar moves. It severs an income stream of $38 million annually. It surrenders voting control over 3 office markets for 40 years. That influence does not appear on any spreadsheet. It is structural power compounding not in dollars but in access and relationships. You build the defense, a recapitalization, a leveraged dividend that returns capital without triggering disposition, a restructuring that gives the activist partial liquidity without forcing full sale. The activist accepts. The family keeps the assets. The family keeps the city blocks. Whitmore looks across the table and says, "You understand now. You do. The tax code is not a fixed wall. It responds to how you build around it. The family that sells pays. The family that borrows does not. The family that holds until the generation turns passes the asset with a stepped-up basis, and the government never sees the gain. This is not evasion. This is architecture. Every family of duration has an architect. Most people never know the architect exists. Now, there is something larger on the table. A position valued at $2.8 billion. Embedded gain of $1.9 billion. Tax exposure between $380 and $560 million, depending on structure. 3 jurisdictions. A similar structure was challenged 6 weeks ago. The outcome is still unknown. You are building something that might not hold. You are building it anyway. because the alternative is permanent subtraction at a scale that cannot be recovered, encoded into family policy across 4 generations. We do not sell. Tax counsel responds in 3 weeks. The consortium's exclusivity expires in 6. Somewhere across the city, a 29-year-old analyst sits at his desk before anyone else arrives. 3 monitors, cold coffee, a model that says, sell. He doesn't know yet that fully valued is not the question. The question is, what happens if you never let go? He will find out. One annotated folder at a time.